Alrighty, we are back. Hello, everyone. Thank you for coming. Welcome. Okay, so this is the last session of the day. I think the bar closes right now if anyone wants to grab a beer for it. What we wanted to do was create a little debate. So yield wars. We talk a lot about stablecoins. We talk a lot about RWAs. There's a lot of convergence and conflation between the two, and also quite stark differentiation between the two. So I'd love for this discussion to be engaged mostly between the panelists of different approaches for what we're seeing right now and then where we think the space is going. So I have a lawyer on the stage. I've got some great folks from DeFi, from TradFi. So tried to bring together a good mix of perspectives that will lead to a well-rounded and healthy conversation. Mark, I want to start with you just so you can kind of scene set a little bit. So with some stablecoins paying yield to users, some not, some being backed by on-chain capital, some by RWAs, can you just give us a kind of context and level set of how you see the world of stablecoin and real-world assets?
Yeah, I can give a quick explanation. So generally I look at stablecoins in three different ways. One, how is it backed? Two, how is it controlled? And three, where's the underlying yield come from? Even if it's yield kept internally by centralized issuers, or if it's shared with users through more decentralized issuers. From like the yield perspective, we've seen a lot more innovation, a lot more development of yield-bearing stablecoins over the past year. Athena probably being the most notable one, which I would actually consider a RWA protocol because they're tokenizing off-chain assets, even though it's a crypto-oriented asset that's providing the yields. But you're also seeing the proliferation of these more modular and composable type stablecoins built on top of Sky, on top of Morpho, on top of Aave, on top of Compound. They're kind of injecting these repo yield-bearing receipt tokens into a basket of different types of other yield-bearing instruments to generate some sort of yield for the user. And there's a wide spectrum of kind of risk and yields from these various products. And we're trying to work with, at Steakhouse, we're trying to work with clients that are, driving more sustainable and durable type yields. And we'll always have a pretty attractive risk return for people that are depositing into them.
It seems yield is the key factor that determines the structure of the stablecoin, the regulatory considerations of the stablecoin. So Eli, thinking about some of the new regulation conversations that are coming out of the U.S. and different structuring of money market funds, stablecoins, RWAs, what are the yield considerations and how does the difference in how that's treated impact how the asset needs to be treated?
Yeah, I mean, it's a big question. So there's a lot of different regulatory structures and non-regulatory structures used. I mean, if you want to categorize stablecoins, I think the way Mark did it is very good. If you're a lawyer, you think about, regulated stablecoins, decentralized, regulated stablecoins, centralized, unregulated stablecoins, centralized, unregulated stablecoins, or regulated stablecoins, centralized. So there's a matrix of 4 different possibilities. And then within those subcategories, there are different legal structures used. And for the yield-bearing stablecoins, there's many different structures used. Some are set up as funds. Some are split with 2 different tokens. Some are done as bond offerings or debt offerings. So there's a whole series of different investor protection analyses that you need to do to look at those yield-bearing stablecoins or even regular stablecoins in some case to know what the real risks are that people are based there. This is all going to change, of course, in the next 6 months probably when they have the U.S. stablecoin bill enacted at the Congress level, and then we get some regulations from the SEC on stablecoins. We're going to have a whole new category of regulated stablecoins. You already have one in Europe. We'll have one in the U.S. The whole market's going to get bifurcated into different types of regulation and structures, and we'll see sort of who becomes the dominant players in then those industries.
It sounds like one of the initial pushes for the stablecoin regulation in the U.S. was to drive demand for U.S. treasuries. Over the past couple of days, it's come out that there might be some additional complexity around that in terms of U.S. versus non-U.S. How do you think that will shake out in terms of the collateral backing of those stable coins and how we see the bill in the end?
I mean, I think there will definitely be a push to ensure that direct access to U.S. Treasuries is only allowed for regulated U.S. stablecoin issuers. I think that's pretty clear that that's going to be one of the things that the administration pushes for. It's certainly something that Circle wants. It's certainly something that the banks will want. We're all thinking about stablecoins in the U.S. now too. But, it's very easy to get access to Treasury yields without having a direct account at the Fed. So there's already obviously many stablecoins that are backed with U.S. Treasuries in an indirect manner. And I don't think it's going to be really possible for the administration or for the regulators in the U.S. to prevent that from happening.
And Nick, you guys are taking an interesting approach with Agora where historically it's been twofold, either keep the yield or pass the yield to users, but you're passing the yield to the partners that you work with, right? And creating this new relationship on chain. Tell us a little bit about your strategy there.
Yeah, so I think there's good frameworks discussed about how to evaluate stablecoins, but how I think about any of these like yield-bearing stablecoins is they're not really stablecoins. They're yield products. Like they're very fundamentally different. I think about stablecoins as like digital cash, right? So cash you would have in your Venmo account or your bank deposits at B of A, right? And the largest providers there are Circle and Tether, and their business model is effectively capturing the risk-free rate and then not passing that through to any one that is driving the utility or liquidity of those assets, right? Other than Coinbase and Circle's case. And so our model is saying, hey, you actually have this large swath of businesses, whether they're on-chain DeFi applications, centralized exchanges, custodians, that are participants in this economic system that have zero value capture, and actually they should be capturing the majority of the value, not the asset issuer. And so what we do is go to centralized exchanges, custodians, on-chain apps, chains, and say, hey, you guys are the ones that are driving our growth. We'll pass through the majority of the underlying float income to you, and we take a small spread on that to drive liquidity, maintain compliance, monitoring, and sort of build out the infrastructure. And that's resonated with a lot of people because 99.9% of the businesses that are interacting with USDC and USDT are out of that economic equation today. And so we launched the stable about 6 months ago. Hit over 100 million in TVL, with a few big launches coming, and I think you'll start to see this model really start to take off. Especially with new ecosystems where we've found it hard to compete is like existing liquidity, on ETH, right? Where you're competing in 60 billion worth of USDC, USDT. But many of these new networks and new businesses are chatting with us and are like, oh yeah, wait, we get to keep the float income? Of course we'll use you over Tether or Circle, right? And in many cases, a lot of the users of these platforms don't actually care necessarily about the stable itself. And so something that we're also seeing is many of these businesses are beginning to abstract away the token itself, right? And so let's say you have an on-chain stablecoin neobank, which could be something very simple like an on-chain wallet address, a Morpho or Aave vault, and it's hooked up to cards, right? They could call it, wallet USD, right? And it's AUSD under the hood. The user doesn't even need to know or care. And now they're monetizing the float. And so, we really pioneered, I think, this model when we started the business a little over a year ago. There's been a few copycats, namely Paxos. But I think, we're doing pretty well. So,
Sam, I want to hear your take on the RWAs versus on-chain yields.
Yeah. So I'll talk about USDS, and in particular, I agree with I'm gonna name Nick about like the on-chain stablecoin environment is largely about yield-bearing products. So for savings USDS, the observation is that there is a lot of relatively safe yield to be made on over-collateralized crypto lending in particular. This has been around since the beginning of DeFi. Maker first launched with collateralized entirely by debt positions against ETH. And so since then, it's taken on a form where it's backed by USDC. But still the vast majority of the revenue that's generated by the protocol is due to the crypto over collateralized lending, which has very, very, very little to no bad debt over the years. It's actually a pretty safe way to get access to the yield that real users are paying for leverage in bull markets. And so USDS is able to provide at least the risk-free rate, but often it can outperform it even by significant amounts during bull markets. So this is where we're positioning USDS. It's now at 8 billion deposits. So we're able to find this balance between liquidity, yield, and just access the best possible risk-adjusted rate between DeFi, CeFi, and TradFi as the fallback with tokenized T-bills.
And a lot of the yield wars are that the tokenized T-bills yields are pretty low. I mean, 4.55%. So then there's a shift towards on-chain yields. Do you expect that there in the future might be a shift instead to other RWA products with higher yields further up the risk curve? Mark, I'll kick it to you. How do you think of like potential yield as it relates to RWAs?
Yeah, I think there's definitely going to be a push for DeFi protocols and DeFi-oriented, yield-bearing stablecoins to integrate more RWAs, especially as at this current market environment continues with, every major cryptocurrency getting completely crushed like it has the past few days, and lending rates continue to compress and borrow rates as well. You're going to see more people try and look for yield elsewhere. And that I think will be a big kind of accelerant to tokenizing various liquid credit and illiquid credit. Securitize is already doing a lot of that with BlackRock and Apollo and other institutional partners. And right now there's quite a bit of friction to access those products, given the regulatory requirements. But I think there's quite a few ways that those products could be injected into the back end of DeFi protocols and try and provide that yield repackaged in a DeFi accessible manner. So, to the extent that we see the lending rates that were observed last cycle where, lending on Aave for the USDC went I think under 2% at some points. If you have T-bills at 4 or 5% and liquid credit at 6.5%, 7% investment grade, why would you leave money in Aave earning 2% if you can access these investment grade liquid credit yields at 500 plus basis points higher?
And just to quickly hop in, I think there's absolutely no risk management or even risk curve in DeFi today. It's very simple, USDC, USDT, AUSD, or people just ape into whatever the highest yielding thing they see. And I think a good example of this is what happened with Usual is very few people actually did their homework on what this was, and they saw, I can get these T-bills with points, and that's not what it was at all. And then you see sort of how negative, the negative externalities from that and how much capital they've sucked up in what was essentially a scheme. So I do hope that there is eventually some sort of risk curve in DeFi, but it's effectively non-existent today. And I'd actually be curious what Sam's thought is too with USDS, right? Because it's they've now had to kind of go and just turn everything into Athena, right? It's and so it's every, Athena really pushed, I would say the rate ceiling, and then everyone had to just sort of shift their entire underlying asset back into Athena to compete. And you saw this from Frax to the DAI and Sky team. So it's been interesting to see, but I hope it changes.
Yeah, I mean, risk, it's no point in talking about yield if you're not talking about a risk-adjusted yield. That's the important number you should be paying attention to. So, and to be clear, so USDS did onboard Athena somewhat recently, but the exposure there, we're capped at 20% at most. And so we can tap into part of that yield. But again, the risk management that the protocol has had since day one has debt ceilings to make sure that there's limits to each of these particular yield sources. So crypto over collateralized loans does remain the bread and butter of Sky today. But when looking to yields across all of DeFi, there's actually not that many options, at scale. You're talking about, there's T-bills, there's lending against ETH and ETH derivatives, Bitcoin, Sol now increasingly, and then centralized exchange, cash and carry. So with the cash and carry, I think there's been some massive improvements over the years with segregated custody We see that with the Bybit hack that happened on Friday. I think this was a perfect case where this could have been a catastrophic failure, but because of the designs of these stable coins, it provides layers upon layers of protection so that users who are sitting very senior, aka the USDS holders, are protected through multiple layers of insurance, multiple risk management tools such as segregated custody, so they're not exposed to the exchange. And really, all of these layers are what you're buying into when you deposit into a product like USDS. And furthermore, so we are actively working on a fairly advanced risk framework for how we do allocation. So we do it somewhat of a manual way right now, but where we want to arrive at is, whether you're lending on Sparkland or Aave or Morpho, it's not that important. Like, of course, there's smart contract risk. It's more important what the collateralization of those loans are. And of the collateralization, we have access to these like 4 or 5 things. It's not that much. So where we want to reach is just having this framework where we're objectively allocating the balance sheet automatically across all yield opportunities on all chains, and then aggregating this down so that the savings USDS can provide the best risk-adjusted rate in DeFi. And that's what we're going for.
Obviously, Sky is definitely the exception. I mean, for a long time, it's been the top tier in terms of risk management among DAOs and DeFi protocols. It's not, unfortunately, not something that all the protocols are doing, and they don't love them.
What should the other protocols learn from what they have done right?
I mean, obviously, you have to get the right experts to be helping you, and that's the thing that Maker's done. Sky's done. They've got Steakhouse helping them. They've got the right sub DAO at Spark now helping them. You have to have the people who are looking at this all day, every day. Otherwise, you can't do risk management properly.
Yeah, I think the protocols have actually done, in like their case, a very good job. It's more like the users don't think about risk-adjusted yield, right? And that's the real problem. And I don't think that's going to change anytime soon, because I don't really think you see much of it in traditional retail markets either. You really only see it among like institutional asset managers and outsourced chief investment offices, right? So until we get like institutions in on-chain capital markets in a really, really meaningful way, I don't think you're going to have a lot of people that are extremely thoughtful about risk-adjusted yield on-chain.
Yeah, and just back to the point about like what Sky has done right historically from like a risk assessment perspective, I think they've been extremely transparent with regards to the commercial and legal structuring and risk underwriting. I don't think there's anyone that's more transparent for how these sorts of risks are considered. And all of it's public. It's essentially a public give. We share everything that we underwrite. And people criticized us for Sky for onboarding Athena to somewhat of a first mover from like a DeFi perspective, and then ended up onboarding it themselves with taking more risk for their own protocols. So, we're happy to kind of have people kind of piggyback on the work that the Sky teams do and the risk analysis that they do. But we would also hope that they're also, being transparent and sharing these different sorts of risk analyses they're doing for the broader ecosystem. Because the best, the best way we can manage risks, and especially systemic risks, is being extremely transparent. That's one of the core properties of blockchains, is you can use this transparency and use it to make better decisions.
A lot of ways, the Bybit hack was a great thing for Athena because it proved the potential worst case scenario, and they did really well. So the silver linings of struggles and challenges like this. Okay, we have a couple minutes left. I asked the panel previously just some predictions and some future state. Where do you guys think we're with some of we all talk about regulatory tailwinds and some progress being made in the U.S. How do you think the change that we're seeing coming out of the Trump administration will impact what we can expect for RWA growth and adoption in the next few years? Maybe I'll start with you, Eli.
Sure. I think it's going to be a bit interesting. It's going to be a little bit different than what a lot of people in the market expect. I think that the sort of the Howey test issues that have been dogging the market on the crypto side are going to remain for a little while, because it's going to take quite some time for those issues to be rethought through and a new framework developed. So those issues are going to remain with us for some time. I think that the real speed of the administration is going to be impacting RWA first. I think the stablecoin bill, I think the approvals of some of the SEC registration statements that we've seen, the one for figure markets for YLDS last week, and I think we can see the removal of the barriers for the banks to hold crypto assets. So I think you're going to see this year a big push on the institutional side. I think the steps that the Trump administration is going to take are going to really impact institutions who want to come into the market, and in a way that's going to really help RWA a lot.
Yeah, I think it accelerates the rate at which traditional financial institutions come into the space, but it doesn't change the fact that many of these yield products are all securities, right? So, that's what kind of why I differentiated between digital cash and then also these yield-bearing stables, because they're really just yield products, right? And so it doesn't change, I think, the situation that those products will find themselves in, but I think you're going to have traditional banks, exchanges start to custody and support these assets in a maybe 2 to 3 years faster than if you had a different administration, which is really meaningful in terms of accelerating adoption of this asset class. And I think what's going to happen is, probably in 3 or 4 years from now, we're going to get to a state where there's a lot of FOMO from late adopters in the traditional finance space. And that's when things are really going to heat up, not just on a product creation standpoint and adoption standpoint, but also M&A. I think you're going to see a lot of sort of crypto native companies that are servicing these niches super well get acquired for premium prices from a lot of these traditional financial services firms that are going to get caught flat-footed.
How do we bring more capital on chain? How do we grow the pie for on-chain capital?
I think this is a big problem with DeFi, is that there's only about $15 billion or so that's like looking for yield-bearing stable coins. And so some of the problems that we're running into right now with growing USDS is like we're starting to hit the caps of how much capital is available. Like between USDS, Athena, and Aave, like most of the capital is in those three products. And so really to grow the pie, I'm looking at, we have a BTC ETF, we have a ETH ETF. Maybe we'll get a Sol one, but stablecoin ETF seems like the next step. And particularly with USDS, we think it's a very compelling product for people who are looking for this sort of yield in TradFi, because the yield is very real. The users, they're paying for, in bull markets in particular, these users are paying for leverage. And we think this is a compelling product for people in TradFi.
One stablecoin or an index of stablecoins?
One stablecoin.
The ETF.
But everybody can have an ETF or, mix and match. But yeah, we're looking at a USDS ETF. I think, could be a very compelling product for TradFi.
Mark, last words?
I'm just really excited to have a, administration and regulatory environment that makes building products in DeFi, and especially at the intersection of DeFi and TradFi, a lot more interesting, compelling, and frankly possible. We're building a lot more types of new products and have a lot more new products under development that we just would not have frankly considered under the prior administration, just due to the way that some regulatory agencies were kind of pursuing founders and kind of builders in this space. So I'm really excited to kind of see what the U.S. tech talent will build over the next 3 to 4 years. In particular, I'm excited about the market structure bill that's rumored to come out. How it's behind the stablecoin bill in Congress, but having some more regulatory clarity there, and actually working with the various regulatory agencies, CFTC, SEC, on how products to be built safely for consumers, transparently, and leveraging the core innate properties of blockchain for the benefit of consumers is something I'm pretty excited about, and just wouldn't have been something that could have been possible in the prior administration.
We've got the tailwinds. We're kicking off a very good year for the U.S., all here in Denver. So thank you guys so much for joining. Thank you, everyone. Last panel of the day here at Society. All right, wonderful.